Welcome to the 10 Mil Club's Standard Portfolio meeting for the first full week of May 2026.
From Nashville,
It's the 10 Mil Club. It's the 10 Mil Club.
Nothing in our videos is financial advice. Don't trade solely on anything we say in these videos without your own due diligence. Our ownership or interest in any security can change at any point in time. We may own it and we may not. Securities that we present may or may not be suitable for you. You'll have your own willingness and ability to bear risk. Any valuations we present in any of our videos are not reliable. We're not showing all of our work and do not comply with any of the standards of the professional organizations to which I am beholden. What is the 10 Mil Club? The 10 Mil Club is an informal group of people that believe that if we could get to $10 million of personal net wealth, we'd have the financial freedom that we actually desire. With that, let's get to it.
It's the 10 Mil Club.
Thanks for joining us. Before we start on stocks this week, this was kind of a frustrating week at the 10 Mil Club. We got stopped out of a whole bunch of stuff. We thought we had some good entries. We didn't. We kind of got shown just how human we really were. I want to show you something real quick that stick with me, please, for 2 minutes. I've met a lot of people across this country of ours, some in person, some over the phone, some simply online, that believe that they can simply trade high-risk securities to wealth. And maybe, just maybe, there are a very small number of people out there who can do that. We're talking less than 5, probably. But give me 2 minutes here. This formula is passed around in academia. It's called Jensen's alpha. Jensen's alpha, if you will, alpha is simply the extra return that you provide to your portfolio based on your actions. Can you simply beat the market, or at least how much more than the market or less than the market do you provide to your portfolio through your actions, buying and selling, holding? The way that's calculated, you have these different components: the risk-free rate, the portfolio return, the beta, or the relationship to the security you purchase, and the overall market, which the proxy of the overall market is more often than not the S&P 500. And this market premium right here, if you've studied finance at all, you'll recognize this last part as the CAPM equation, or the capital asset pricing model. Basically all it is it's your portfolio return, which if we're worried about one security, we can say the return of a security minus the CAPM equation. Just want to talk about this for a minute. So there are a lot of people online who act as if you can simply crush it. You can find these, you can find setups, and you can just make, I'm not going to name them, because if you so much as question, I'm not afraid of them, but I just don't want to get into it, because if you so much as post anything or say something that you question their methods or that they can actually do it, what you'll get is a lot of loud attacking rhetoric back at you, which, by the way, is a fallacious argument. It means that they're hiding something. There may be a very small number of people in this country or in the world who can actually find setups and trade really high-risk securities into a profit. But you got to remember that you have to be able to do this consistently over and over and over again. And I'm going to talk about just the likelihood of that. One of those stocks that was mentioned, I mean, understand, there's one person I follow, and one of the giveaways is that the person won't give you his or her name. What the person will do is have a handle and a logo, and you'll never really know who the person is behind all of it. And this particular one that I'm referring to is that way. But so this was just one that came up. AEHL. I'm just going to pull it up here on Thinkorswim. This is 6 months of AEHL. Yes, this over here is $9 a share. This is $23 a share. This is $1.20 a share. The big point being that there's a large volume day right here on May the 8th when they announce a realized gain from this, whatever it is, and then there's this spike. So what you get from these people online is this right here. Whoa, look at this. This is way up. Okay, yeah, it is. But let's look at the past 6 months. They look like this. Let's look at the last year. Last year looks like this. And the reason it looks so flat is that this is a 200-day moving average. And you're probably thinking, Mark, look, I'm not interested in holding it for a year. I'm only talking about holding it for maybe a day or two. Okay, fine. Okay, fine. That's all right. But let's just run the calculations on this real quick. So this over here, no fooling, a year ago, it closes at $14.88, and it's now at $1.20. Along the way, it has these spikes and things, but this is a downward moving stock. We can absolutely, we can see it very, very easily if we simply do the appropriate look on it here. All right. So back to Jensen's Alpha here. What we're saying with AEHL, so that's a year of down. It no joke, it has a negative 91% return if you had held it for a year. And I can hear you out there going, I'm not going to hold it for a year, I'm only going to hold it for a day or two. I get it. Work with me here. Negative 91%. So if you then plug in all of these things that I looked up, 0.81 beta, 3.75% 1-year Treasury, 10.25% 50-year Standard & Poor's. If you run those numbers, what you end up with is a Jensen's Alpha of negative 100%. In other words, if you held it for a year, and I'm going to talk about that, if you held it for a year, you will add to your portfolio negative 100% because of the opportunity cost out here in the CAPM part of the equation. So if you just simply want to break even, what do you have to do? You have to get 9.015% on a trade on this stock that has, and understand, stock after stock after stock are posted online like this, like, ooh-wee, look at this. You can make a ton of money off of this. Well, okay, but what that means is that you have to make in excess of 9% on this stock that has negative 91% return over the last year. And you have to do all of it by the strength of your own arm. You're not getting any help from the market for that stock at all. Does that sound like a really good decision to you? Because if it does, if that sounds like something you really should get into, we don't make a lot of recommendations directly to people on this show, but I would heavily recommend that if that is something you think is a great sounding idea, that you immediately stop trading and take your money and take it down to some investment manager who can put it in something that will actually make some money for you. And maybe you find a second job and quit spending so much time in front of the monitor. Because this is a losing proposition. That spike, yes, it's a spike. But how many other spikes do we have in here? You've got to be ridiculously good at trading in order to pull that off. It's just, it just doesn't, you're swimming against the tide. Why not swim with the tide? So honestly, you probably are better off getting a second job and making yourself some money. Let's get into what we actually saw in the market this week. Thanks for listening to me. That's been weighing on me. I just wanted to talk about it for a minute and you know, it bothers me that there are people out there who are trying to con folks into this. That doesn't mean that something couldn't change and we could see a penny stock turn and go up. Yes, you should be researching those things, but if your intent is to hold that for just a day or two and up we go, I don't know. Let's put a little more thought into it. Let me put it this way: the 10 mil club's not built on that, and we're not looking to go to war with anybody. But anyway, it was a tough week for us. This is the put call ratio, which is strikingly low. Little over 30% puts divided by calls. That means that more people are actually buying calls than puts, which indicates upward market momentum, and the volume on that is up as well. I'm really kind of surprised about that. However, I will say this: the put call ratio is quite often viewed as a contrarian indicator. When it shows a bullish market, quite often the market's overbought and about to roll over. So just something to think about. This is the percentage of S&P 500 companies trading above their 200-day simple moving average. You can see that figure is dropping. We're actually at about 53, a little over 53% now, and we felt that. I mean, this week there was a drop. We felt it. This is the percent of S&P 500 companies trading over their 50-day moving average. We're ever so slightly over half. So we felt it. The VIX is actually down. So 20 is kind of viewed as the magic spot for the VIX. Above that's elevated, below that's not, and it's been dropping. However, there's about an 80% negative correlation between stock prices, which we could proxy using the S&P 500, and the VIX. About 80% of the time, you'll have the VIX dropping and stock prices going up, and vice versa. That has not been the case this week. If we're looking at the S&P 500, this is the S&P 500 index. It's hitting new highs, and the VIX is dropping. That's true. But what we're getting is a declining breadth, a declining number of companies that are trading above their 50 and 200-day moving averages. And there are just some things that are bubbling under the market surface I don't like. I don't like the feel of, and I felt them this week. So the MOVE Index, which is the VIX for bonds, is also not showing trouble. But again, there's some stuff that's bubbling underneath the surface. What we saw this week in the 10 mil club was we saw companies with earnings beats, sales beats, and sometimes even raising their earnings and sales guidance with their stocks going down. It just seemed to be a negative bias to it to us, and we didn't like the feel of it. All right, rapid fire, let's go through everything we're looking at. If something disappeared off of our list, you were paying attention to it a week ago, if it just disappeared, it just means that the pattern quit being interesting to us and we quit watching it. ADPT, we actually are watching. It does have higher lows, but it doesn't necessarily have higher highs. So we're still watching ADPT. BorgWarner had really good earnings and the market reacted very favorably. BWA, I would expect BorgWarner to kind of migrate back, but not a bad buy. They certainly, this is the I guess you can't see that, but quarterly earnings of $1.24 a share, a 11.71% increase of earnings over the same period last year, and a 0.51% increase over sales of the same period last year, and the market cheered that, and their stock went up in the later part of the week. I wouldn't be surprised to see a retracement back, but we're still watching it. Car Gurus we still own, CARG. Now, this one is curious because the news down here is interesting. So here's Car Gurus. Let's see if I can get that. All right. So quarterly earnings of 58 cents a share beat the analyst consensus estimate of 57 cents a share by a small amount. It's a 26% increase over earnings of the same period last year. They had an 8% increase over sales of the same period last year. I believe they raised their sales guidance. No, they affirmed their sales guidance. Okay, they affirmed their sales guidance, and that sent the stock down. Now, we didn't get stopped out because we've owned it long enough, but it certainly, for the moment, wrecked this upward movement of ours, and we're only up 8.29%. A lot of our profits kind of went down the drain on that. A little surprised, don't it? If we don't see improvement over the next few days, we'll probably sell CarGurus and take a little bit we have in it. There should be a dead cat bounce. Honestly, that is also us trying to, at the 10 mil club, trying to forecast where a stock's going, and we don't know that. Century Community is one of the big disappointments of this week. We bought this. Now remember Jensen's Alpha. We decided on this one that we had a small amount of uptrend, but we were down here. We thought maybe leaning on the strength of our own arm's flesh, we could maybe trade this up. We bought it at 55.60 and we got stopped out on it before the week was up. And now it's back to 55.01. Such is the risk you take. This was disappointing. We're still watching it because honestly we believe it's a home builder. Home builder's not doing great. Interest rates going up. And if I might pause just for a minute, when money gets pulled out of the economy, there are a couple of ways for that to happen. One way for that to happen is for the Federal Reserve to raise interest rates, but another way for that to happen is for a commodity that everybody uses to go up in price so that everybody pays a lot more for it. And that's the way it is with oil and gas right now. Every single thing that uses oil and gas, we understand there's a jet fuel shortage, gasoline's higher at the pump, natural gas is more expensive, everything petroleum input is more expensive, and it's looking like it's going to be quite a while before we get down below $100 a barrel oil. And that is going to pull money out of the economy. It's going to make so that people don't have a down payment for a house, and Century Communities, being one of the better run home builders, we thought, well, you know, we'll buy it down here, and we put a very tight stop on it. On this one, we didn't put a 7.5% stop on it. We put about a 1% stop on it. It stopped us out. We only lost a couple of $100. Still annoying, but not as bad as it could be. So anyway, we're still watching CCS for some sort of entry. CMC, Commercial Metals Company, we actually bought earlier in the week, and we are up a little bit, 3.67%. Very grateful to have one that's up. EXPD has upward momentum. It had its earnings, which dove the stock, and then the stock came back. My guess is the stock would resume somewhere around in here and give us a buy-in, so we're watching EXPD. FCX bounced. We have not bought it yet, but in a higher inflation environment, which is kind of where we are right now, commodities are one of the things that you want to lean your money toward. And so Freeport-McMoRan is one that we could have simply bought it down here. We didn't yet, but we're looking for a little less volatility in order to do that. This was the biggest, FDMT, this was the biggest disappointment of the entire week. You think, a bigger one than CCS? Yes, this was the biggest one. I'm going to put up here 5 days, 5 minutes. All right. This is earnings. We had somewhere in the neighborhood of, if I remember correctly, 12 to 14% profit on this stock. And we went into earnings. Now, you might think, well, why did you carry it into earnings if you consider yourself a wily trader? I don't consider myself a wily trader, for starters. And second, we figured that we would probably be okay. And that's what you get, right? When you figure out, when you figure you're going to be okay, maybe I need to learn some things about trading. Maybe we here at the TMC need to sit down and consider our trading strategy. It kind of started backing off before the earnings itself. And then the morning of the earnings, it went right down, stopped us out, and then closed up 20 cents on the day. We were not having a good day that day. Let's just call it that. We haven't bought it back yet. It's hard on these biotech companies, especially when they don't have positive earnings, because this one doesn't. But you can see why we bought it. Here's the year one day. You can see the upward momentum. We just simply got stopped out. Now, we had raised the stop to our buy-in price. As you can see, we actually lost a few cents, but we didn't get killed But opportunity cost, we kind of did. So we'll see. We'll see. We're looking for another entry back into 40 molecular. Maybe the lesson is don't go doing anything around earnings, but it could have just as easily leapt as done what it did, but it stopped out, and that's just the way it is. We're still up a little bit on Fox. Fox has its earnings Monday, and you think, well, are you about to make the same mistake? I don't know, to be honest with you. We are up a little bit. We probably should raise our stop a bit just in case. But for the moment, we're up a little over 6% on Fox. FUBO, we do follow. FUBO's earnings came out, and now they're at $10.28 a share. I'm going to do this again. Here's 1 month, 1 hour. We took a flyer and tried FUBO back over here. It didn't work. Then our favorite person, Creative Ostrich 4066, was like, FUBO's on the move. Yes, it was, CO 4066, and then it did this, and then it did this, and now we're down here. Would love to hear what you have to say about it, because it's got to be good entertainment. It always is. But FUBO, if I recall correctly, it's down here. Let me pull it up real quick. FUBO was, okay. They had a 314% increase over sales of the same period last year. You need to bear in mind, though, that's pre-merger. So this is AI writing something and not taking that into account. So that's pre-merger, and so are the losses and everything. You'd have to really dig into FUBO's earnings to really understand kind of how it worked out, and maybe we'll do a follow-up on FUBO. But for now, the chart is still not a good chart on FUBO, but we follow it. HCSG, we made quite a good amount when we sold HCSG. It's come down, it's headed back up. We are watching HCSG for another entry now that we kind of can see HCSG forming this base right here. KRMN, I just wanted to touch on. We bought it because we thought, well, we're at war, Iran, Strait of Hormuz, and so we bought it at the strategic point right here. It stopped us out. It was a bad week that week, which was, I believe, just last week. And now we were stopped out at 76. Now it's at 60.84. And so for now, we're looking like we're pretty happy. Or at least, let's put it this way. We did not get killed as bad as we could have. Lemonade we bought. This was another annoyance this week. We bought it. We thought we did pretty good. We bought it at 56.55. It stopped us out at 52.30, and now it's back to 55. So we're looking for another entry on Lemonade. I think it's probably a pretty good stock. Rollins, we got stopped out also this week. Look, we bought 5 things and got stopped out on all 5 of them this week. That's just the way it is. Just simply could not keep the momentum going, and so we got stopped out on Rollins. And we're still out. Looking for another entry, but we'll see. ROST stores were almost at even money, despite our buying it all the way back here. I say all the way back here, early April. We haven't owned it all that long. But we'll see. Still looking for an entry on Service Corp International. This is a death care company we like, SCI. SOFI we actually bought into and still own and have not been stopped out yet. Now, we are close to getting stopped out. 15.75, our stop is at 15.38. We came within a few cents of it a couple of times during the late part of this past week, but still have not been stopped out. We'll see how that goes, but not looking great at the moment. We are kind of sucking wind on TJX. You look at a year of it, this is an alarm for me. So TJX, which is the parent company for TJ Maxx, Marshalls, Home Goods, we've done a deep dive on this alongside Burlington and Ross. This holds a unique spot in the retail ecosystem because they actually, what are they called? Off-brand retailing, I believe they're called. And they take higher branded, higher priced merchandise and then sell it at a lower amount to a public that I would think would be stretched, a consumer that would be stretched. And that may be true, but the stock itself really just has not done all that great lately. Not really in danger of being stopped out. Still up a little bit, 1.15%. We'll see what happens. We keep it on our list because we own a pretty nice sized position in it. And we always follow TMC, the metals company, because we get inquiries all the time if we follow TMC. We have not done a penny stock spotlight on this yet. It's debatable whether $5.70 is a penny stock. There is some saber rattling here among the ownership of the company that they are underappreciated because they've been given like a partial license. They're waiting for certification and all that kind of stuff. Well, okay, but that doesn't change the fact that you still have zero revenue, and we're all still waiting. It did, however, cross this line, and with a bit of up volume, cross it, I guess in anticipation of these earnings, but be really, really careful because right now, stocks with even good earnings are getting killed. The Vera Bradley, we are still down just a slight amount. We must have just bought that too high, but the stock continues to move up. It's in accumulation mode, and this relative strength line, it's outperforming the S&P 500, if you can believe that, over the last couple of months. So see how that goes. Verizon still have an eye on. It's kind of curved back to the line. VZ, we're watching it. Again, there's some stuff we like about Winnebago. Winnebago has higher lows, but it also hasn't shown us higher highs. It's consumer discretionary, and so we have it on our watch list. Walmart, my brother bought a substantial holding in Walmart, and he's probably not doing too bad. Foolishly, we got stopped out a couple of times on Walmart. It's probably one you should just buy, but you cannot buy things without a stop. That's just the way it is. YETI, we're still watching. It's also consumer discretionary. So we are... If you've noticed, we actually have a smaller amount of stocks this week, and I did a little bit of a discussion about Jensen's Alpha, and the reason is because I just don't get in a way in this market where you think I've got to trade myself to a whole bunch of money. It just doesn't work well when you try to start swimming against the stream because you just simply think you're a strong swimmer. It just doesn't seem like the way to go. So that's the way we see it. From all of us at the 10 Mil Production Room, Laura Sue, Will, and Mark Thomas in Production and Engineering, Sophie, Hannah, and Presley at the 10 Mil Club Singers, and Jackson, our announcer, we will see you next time on the
10